Hello, everyone. Today, my team and I, team number 5, will present the case analysis of Tiffany Co., focused on its expansion into the Japanese market and the financial risks the company faced after changing its business strategy in Japan. Okay, so first, to better understand the case, it is important to first understand what Tiffany Co. is. Tiffany is a luxury jewelry company founded in New York in 1837. It is globally recognized for selling high-end jewelry, especially diamonds, as well as watches and luxury accessories. By 1993, Tiffany had become a very strong global brand and was growing quickly in international markets, and the company was opening stores across Europe and Asia, and also investing heavily in global expansion. This international growth created major business opportunities for Tiffany, but it also increased financial exposure and made the company more vulnerable to risks in foreign markets. So, even though the company was growing, expansion also created new financial challenges, what management had to control carefully. So, why Japan was important? One of Tiffany's most important international opportunities was Japan. At that time, Japan had one of the largest luxury jewelry markets in the world, worth around $20 billion. Even though the market was very large, Tiffany only had about 1% of market share, which meant there was still huge growth potential. This made Japan extremely attractive for Tiffany's long-term strategy. So the company believed that if it could increase its presence there, it could significantly increase future revenue and strengthen its international position. So, however, there was also an important challenge. That was that Japan's economy was beginning to slow down and consumer spending on luxury products was becoming less predictable. So while Japan represented a major opportunity, it also became a more uncertain and risky market. Okay, so what changed in 1993? Before 1993, Tiffany sold its products in Japan through Mitsukoshi Limited, which was a large Japanese retailer. This meant Mitsukoshi bought Tiffany products wholesale and then sold them directly to the Japanese customers. Mitsukoshi handled the stores, the sales process, and most importantly, the currency exchange risks. This made things easier for Tiffany because it received payment in dollars and did not have to worry about changes in the Japanese yen. But in 1993, Tiffany changed this agreement. So the company decided to take direct control of pricing, inventory, marketing, and store operations in Japan. And this gave Tiffany the chance to earn higher profits and have more control over its brand image. However, it also meant that Tiffany would now face financial risks that Mitsukoshi had handled before. So these were the benefits and the new risks. For the main problem, the core financial problem, this created the main financial problem because of the case, the currency risk. The currency risk was the main problem. After taking direct control of sales in Japan, Tiffany began receiving revenue in Japanese yen. Since Tiffany is a US company, it must convert that money into US dollars for financial reporting. The problem is that exchange rates change constantly. If the yen becomes weaker compared to the dollar, Tiffany would receive less money when converting its Japanese revenue into dollars. This will reduce reported profits and create instability in earnings. So the key question for management became, should Tiffany protect itself against these exchange rate risks? And if so, what would be the best way to do it? This is the central financial decision that the company needed to make.
Before analyzing the currency risk itself, it is very important to understand Tiffany's financial condition in 1993. As we can see, the company experienced a significant decline in profitability over 3 consecutive years. Net income fell from approximately $36.7 million in 1991 to only $15.7 million in 1993. At the same time, operating income dropped dramatically from 67.8 million to $26.7 million. This decline happened even though Tiffany continued expanding internationally, especially in Asian markets. According to this case, Japanese demand for luxury products slowed during the early 1990s because the Japanese economy weakened and customers became more cautious with the spending. The key issue here is that Tiffany was considering a period of greater financial exposure while its profitability was already deteriorating. Lower earnings meant the company had less capacity to absorb unexpected losses caused by exchange rate volatility. In other words, the timing of the Japanese restructuring increased financial risks at a particularly sensitive moment for the company. Okay, so the next issue is the actual exchange rate. Tiffany Risk inherits after restructuring the Japanese operations. Before 1993, Mitsukoshi purchased Tiffany products wholesale in US dollars, meaning Mitsukoshi absorbed the currency risk. However, after the agreement changed, Tiffany started receiving sales revenue directly from the Japanese yen. This created a major new financial exposure. So, looking at the exchange rate trend, we can see that the yen appreciated dramatically over the previous decades. The exchange rate moved from around 251 yens per dollar in 1984 to approximately 106 yen per dollar by the mid 1993. At first glance, a strong yen benefited Tiffany because the yen revenues translated into more US dollars. However, the case also mentions that there was a concern that the yen had become more overvalued based on purchasing power parity theory. The PPP basically suggests that the exchange rates eventually adjust towards relative inflation and price levels between countries. So even if the yen later depreciated, Tiffany's Japanese revenues would convert into fewer dollars directly by reducing reported earnings and increasing earnings volatility. This was especially dangerous because Japan represented one of the Tiffany's most important growth markets for the future. Okay, so now to better understand Tiffany's exposure, we can evaluate different exchange rate scenarios. If the yen continued strengthening, Tiffany would benefit because Japanese sales would translate into higher dollar revenues, and if the exchange rate remains stable, the company could forecast some earnings and more accurate and maintain predictable cash flows. However, the most concerning scenario was the sharp depreciation of the yen. In this situation, Tiffany's translated revenue and profit margins would decline significantly, earnings would become more volatile, financial forecasting would become more difficult, and investors could perceive the company as risky. This is important because international expansion was becoming a central part of Tiffany's long-term strategy. By 1993, the company had already expanded from 31 to 79 retail locations worldwide, and with Japan representing a major growth opportunity. Without some form of currency protection, the success of the international strategy could become highly dependent on the unpredictable movements in the foreign exchange markets. For that reason, Tiffany needed to evaluate whether hedging instruments like forward contracts or currency options could reduce the downside risk while still supporting future growth.
Hedging theory framework. In this slide, we analyze why companies use financial hedging strategies. Corporate risk management theory states that companies seek to reduce the volatility of their earnings and stabilize their cash flows. This allows them to better plan their finances, mitigate the risk of financial distress, and protect shareholder value. In the case of Tiffany Co., currency hedging become especially important because the Japanese market already represents a significant portion of its international operation and was still growing rapidly. With the new agreement in Japan, Tiffany began receiving revenue in yen, this becoming directly exposed to fluctuation between the yen and the dollar. Therefore, managing this currency exposure was not just a financial decision, but a strategic necessity to protect the company for future stability. The alternative one is forward contracts. A forward contract looks in a future exchange rate for selling yen. A forward contract allows a company to lock in a future exchange rate today, selling yen and receiving dollars later. This helps eliminate uncertainty about how much money the company will receive in the future. Among its main advantages are the stability and predictability of cash flow, and its implementation is usually relatively expensive. However, it also has disadvantage if the yen strengthens in the future. Tiffany will not be able to benefit from that favorable moment because the exchange rate will already be locked in. Furthermore, it reduces some financial flexibility. In financial terms, this alternative offers solid protection against losses resulting from a yen depreciation, although it limits potential additional gains. The second alternative is currency put options. This a put options gives Tiffany the right, but not the obligation, to sell yen at a specific exchange rate in the future. The main advantage is that it protects the company if the yen loses value, but at the same time allows it to profit if the yen strengthens. This provides greater flexibility compared to forward contracts. The main disadvantage is the cost of the premium that must be paid to acquire the option, which makes this strategy more expensive. Financially, put options offer a balance between protection and opportunity as they limit downside risk without completely eliminating profit potential.
Recommendation and implementation. After analyzing the financial risk and the available hedging alternatives, our team believes that Tiffany should use currency put options as its main hedging strategy. We select this alternative because it provides protection against the yen depreciation while still allowing Tiffany to benefit if the yen becomes stronger in the future. Unlike forward contracts, put options offer a greater flexibility. This was especially important because Japan represents a very important growth opportunity for Tiffany during the early 1990s. And on this slide, we also included a simple implementation plan. Like first, Tiffany should estimate its expected yen cash flow from Japanese operations. Second, the company should hedge only a portion of projected revenues using correct currency put options. And third, management should continuously monitor exchange rate movements and market conditions. Finally, the strategy should be reviewed and adjusted regularly depending on volatility and business performance. Overall, this approach will help Tiffany reduce uncertainty while maintaining long-term growth potential. In the next slide, we have the risk management, and even though put options provide important protections, there are still several risks that Tiffany will need to manage carefully. One important risk is the high premium cost of options. Since the strategy is more expensive than forward contracts, another risk is incorrect exchange rate forecast. If management makes poor predictions about the yen, the hedging strategy may become less effective. In addition, with Japanese demand,
could reduce revenues even if the company successfully managed currency exposures. To reduce this risk, Tiffany should hedge only part of its exposure instead of covering all revenues, and the company should also maintain liquidity reserves to preserve financial flexibility. Finally, management should review head positions quarterly and adjust the strategy when market conditions change. This balanced approach will reduce downside risk while still supporting international expansion. And finally, to conclude our conclusion, Japan represents a major growth opportunity for Tiffany and CO, but the new business structure also increased the company exposure to exchange rate risk. By taking direct control of operation in Japan, Tiffany gained higher profit potential, but at the same time became more vulnerable to fluctuations in the yen-dollar exchange rate. As we explained through their presentation, a significant depreciation of the yen could negatively affect report revenues, earning stability, and investor confidence. For this reason, our team concluded that the currency put options were the most balanced solution because they provide downside protection while preserving upside potential and financial flexibility. Overall, effective currency risk management became strategically necessary to support Tiffany's long-term international growth and financial stability. Thank you so much for your attention. And here are our references. Thank you.